I'm Neetha Bidway. Welcome to Good Revenue. We have a ton of topics for you today, so we're going to jump right in, starting with industrial policy, the march towards mercantilism, and the AI chip wars. Then we will get into some of the latest research from MIT that might be helpful to you if you're thinking about AI efficacy in your organization, especially if you're in an enterprise org. We'll also talk about some pretty chilling news about cybersecurity concerns tied into AI agents, and then we will talk about the markets, both a really bizarre pump and dump scheme that seems to have emerged in public markets, public companies. And we'll also wrap up with a quick update on what is going on in the venture market, because it doesn't look great for everybody. As always, you can find links and resources in our show notes. We love data and we try to keep track of all the sources that we find and reference. And if you haven't already, hit the subscribe button. Thanks for joining us. First up, we're going to talk about US industrial policy and the march towards mercantilism. Now, if you've got to flip open your history books, this is a system of economics that predates capitalism. In fact, Adam Smith was a critic of mercantilism. And so if you're an advocate for capitalism, you may or may not be a fan of where we're heading. But nonetheless, let's get into some of the data and news. So the US just bought 10% of Intel for $9 billion. This was funded through the CHIPS Act, which was funded during the Biden administration. It marks another step in this new bold era of government intervention in the semiconductor industry in an effort to shore up the dominance of US manufacturers. Now, the deal terms include the fact that it was a passive equity stake, so that means the US won't have control of the board. And the public statements about it indicate that the government feels this will help us reduce reliance on Taiwan and other overseas competitors. But there are a lot of open questions about how this is going to work in practice and whether this industrial policy is going to expand to other areas of tech or other areas more widely. So, in that vein, we did a couple episodes over the summer about industrial policy, and we will link to them here. One of the ones that really caught our eye had to do with the Pentagon investing in supply chains, particularly when it comes to rare earths. They bought a large stake. They're now the largest shareholder in the only US rare earths mine. And there was also the recent decision to take a 15% cut of exports made by Nvidia and AMD if they sell their chips to China. Now, this 15% cut is very controversial. It's sparking some debate as to what the government's role really should be and whether or not we should have something like this. So I think this is a very complicated question for a lot of legal and constitutional scholars. But across the board, I mean, there have been significant investments in semiconductors this year. We're looking at about a $600 billion investment in semiconductors. Some of the notable corporate contributions include Micron. They've committed $200 billion in manufacturing and R&D. Texas Instruments, they're expected to spend $60 billion across 7 labs, including in Texas and in Utah. TSMC, they've committed to spending about $100 billion in US-based manufacturing. And Nvidia, they have also committed $500 billion in AI infrastructure and manufacturing. And this is in addition to other commitments from firms ranging from IBM to AMD and global foundries. The backdrop for all of this is that the CHIPS Act, which was passed in the last administration, provided a lot of funding as well as advanced manufacturing credits for these companies. And so it remains to be seen what comes of this. But certainly it's been a bipartisan, consistent commitment to have support for semiconductors. I think the question is whether or not this is the path that's going to make the most sense, both short term and long term. Now, semiconductors are going to stay hot for the foreseeable future, just based on the trajectory of AI. They grew 19% in 2024, and in 2025, they are set to hit record revenue totals, trending towards $1 trillion by 2030, according to Deloitte. So this is a huge business. And the big question is, how far does the government plan to go in picking winners and losers in this sector or in others. The chip wars are ramping up. So, China is actually now pressing companies to adopt the use of Chinese made chips, namely by Huawei, but also by others, over the chips made by Nvidia or AMD. And this is because they are allegedly concerned about backdoors or security risks. Now, this is super interesting, and you can find reporting in the Wall Street Journal and Euronews, as well as some other sources. So, this continues to be a really complicated trading relationship between America and the Chinese. Some of the fallout from this decision or this rumor seems to already be felt. NVIDIA has apparently told suppliers, including Samsung and Foxconn, that they need to halt production of H2 chips, which are a lower tier of chip that NVIDIA was making for the Chinese market. They are also planning to build a new chip that's compliant with the rules that the US agreed to just a couple weeks ago. But all of this seems to be adding some more uncertainty to both manufacturing process and on an ongoing basis, really, to the regulatory process. It seems pretty clear that China wants to be self reliant when it comes to AI chips and the supply chain. And one thing I wanted to just leave you with way back in January, if you can remember that far and it hasn't been memory hold, when DeepSeek hit the news, one of the things that security researchers and analysts pointed to was the fact that it was very likely that there had been some chips that are actually barred from sale in China. It was quite possible that they may have actually been used by DeepSeek, and that might have been one of the reasons why they were able to make such serious advances in such a short period of time. So, regardless of what actually did or didn't happen there is an ongoing, really fraught battle between countries, obviously all around the world, but particularly the US and China. And we'll continue to track that story. AI meets gravity. So we've got two AI stories for you this week. So MIT just released a new report called the Gen AI Divide, and it covers 300 public projects in the enterprise. And we're talking about a scale of investment between $30 billion to $40 billion. The yield that they found from all of this is that 95% of organizations reported zero financial returns, which is striking. And I think a lot of people are not going to be thrilled to hear that. But there is some interesting, I think, positive glimmers in the 5% of entities that report that they were able to actually extract millions in value. And here are some of the specifics. First of all, the research report talks about the patterns of failure, and it notes the fact that even though these tools have been widely rolled out, so your ChatGPT, Claude, Copilot, whatever it may be, they are really geared towards individual productivity instead of P&L impact. And so that is one of the challenges, that even though 80% of enterprises have piloted or seriously explored generative AI, there's a little bit of a mismatch between how these tools are actually being used by employees and across the org versus where the business returns live. The enterprise grade and custom vendor solutions really do not seem to be going well. And that's also an important takeaway if you're in an enterprise looking at this. The reason cited by the MIT report is that most of these projects are being rejected because the workflows are really brittle within the organization. And any of us who've been in a large company, especially if it's a large public company, I think can attest to some of that. In addition, MIT notes that there is a lack of what they call contextual learning, and there isn't a lot of alignment within operational roles. So there's some layered issues there in terms of the failure points. Now, the themes that they found, first of all, limited disruption. So only 2 of 8 sectors are actually showing structural effects, like positive effects from Gen AI. There's also something called the enterprise paradox, which means that even though large firms are doing lots and lots of pilots, they're actually getting less scale than a smaller organization or a mid-size organization. There's also some bias in how funds are being allocated, which I thought was really interesting. more than 50% of the budgets are allocated towards sales and marketing projects and or tasks. And certainly if you're, floating around LinkedIn, that certainly seems to be where all the money is going. But the researchers found that the real ROI is actually in back office projects. So that I think is really helpful. And then the fourth thing that they mention is that there is an implementation advantage. So the partnership models seem to actually be outperforming internal builds. And I think that's also interesting because if you've been here before, we've highlighted a large scale deployment of a private build that Walmart did, which seems to be the only significant big public success story that I've seen in recent months. And frankly, if you've heard of anything else that's a private deployment that is doing really well, and you can share about it, we'd be interested in learning more. Across the board, what MIT has found is that the barrier is that AI fundamentally is unable to learn and adapt to the context. And because there's no way to actually store those learnings and insights in the AI and kind of continue forward, that's the real challenge. The challenge is not regulation or infrastructure or even talent gaps, which was very interesting. And then the final point from this is they found that winners, so within that 5%, were succeeding because they were demanding customized outcome based tools. And they were selectively using this in areas like customer support, engineering, and in administrative tasks. So, really interesting findings from this particular report. And if you're interested in kind of the state of AI widely, we're actually going to do a deep dive next week. So, come back for that if you want even more on this. And our last AI story for today is about AI agent security threats. And this comes out of Black Hat, which just took place a couple of weeks ago, and it can be found in Dark Reading. Comes to us from the company Zenity. So they made a discovery, which they talked about at Black Hat, and that is that AI agents, which are the enterprise integrated assistants, are vulnerable to zero-click exploits, which means that it's possible for an attacker to take over agents with just an email address. And it's dangerous because agents are already getting access to things like emails, calendars, your docs, obviously, other SaaS tools. And because these agents are able to act autonomously with a high degree of privilege and access, that makes them really attractive to security threats, and it makes them very attractive to attackers. The research team at Zenity noted that prompt injection defenses are mostly ineffective, and they demoed something called Agent Flyer to show how powerful this problem is. They also noted that it is a real challenge where the adoption of AI agents is outpacing the capacity of the enterprise to actually safeguard this. And in addition to expecting your SaaS vendor to meet strong security standards, their contention is that it's really important for enterprises to do more on their own cyber defenses and security to really get at threats like this, because you will never see it coming otherwise. Let's talk about the markets a little bit. So, you would be interested to know that a classic scheme from the 80s, the pump and dump, seems to be back with a vengeance. So, that's our first topic coming out of some reporting from the Financial Times. And I'm going to link to both their news articles and a really interesting podcast episode because I love podcasts. And if you do too, I think this is worth listening to because there's a lot more color than what we can cover here. The FT reported that they have found a number of microcap public companies. They're often biotech firms, and they are listed on NASDAQ. That is the thing that I find so unbelievable about this story. But these are companies that are about $25 million in market cap with a very limited float. So executives control 80% of the shares of the company or people within the company, and just 20% is actually available on the market. And according to this reporting, these companies appear to be based in China, Singapore, and Hong Kong. The scheme seems to be starting in WhatsApp and in Facebook groups where people are apparently being convinced that because these are public companies, they're actually safe. So there's a real challenge here because on the one hand, I think certainly as a As an investor, I think we have the impression that companies on the public markets have to adhere to higher safeguards and rules. And that is true in terms of reporting requirements. But the challenge of a scheme in which someone is artificially pushing up the value of the stock only to dump their own shares and to leave you, the investor, with the remainder, that's a little bit harder to track and to enforce. Now, based on the criteria in the Financial Times, our team was also able to find 6 examples of companies that might fit this criteria. So it does seem like something you could look at if you're aware of. So that's why we wanted to just flag this, and in the hopes that people are still going to be doing consumer protection, because this is the kind of thing that, if you're a retail investor minding your own business, this could be a real challenge and a real wake-up call for you, unfortunately. And our last story, there's a little bit of a bifurcated fundraising environment in venture capital. So according to reporting from PitchBook, and we've seen some similar data from Carta, first-time managers are having a really tough go of it. Of the folks that raised a fund in 2021, only 33% have been able to raise their second fund. And of the 2022 vintage, just 12% have been able to. And the reason why is the returns on venture capital have been really disappointing in the last few years, and limited partners are not happy about it, and they're seeking liquidity. We've also done stories recently on the secondary markets and on zombie unicorns. We can link to those too if you want more context. But all of this is really interrelated to what seems to be going on here with first-time funds. Now, larger, well-established funds seem to be doing well. And so the wider theme is that capital is becoming increasingly concentrated. The question is, does that mean that risk profiles will change? Will we see less innovation and less novel investing? Remains to be seen. As always, thanks so much for joining us, and we will see you here soon. Thanks for listening. If you liked what you heard, leave us a review, subscribe to the show, or check out another episode. We appreciate your support.